According to supply managers in the 9 Mid-America states, how is the economy performing?
Creighton's survey of 9 Mid-American states, the survey of manufacturing supply managers, the overall reading from the June survey was down a bit, down to 50.7 from May's reading of 51.0. Now this is still above growth neutral, but the direction of the manufacturing economy, according to our index, is slowing down, getting slower and slower and slower. And it's much like the national reading, which will come out later on this week, also showing that the manufacturing economy in the U.S. is slowing down with fewer and fewer jobs, I would say, but growth is holding up there reasonably well. The import reading was not strong at all, down to 30.0, and that's from 29.8 in May, and that's something to be really concerned about. What happened is we got a lot of push forward. In other words, manufacturing supply managers, they bought heavily in the first quarter because of front-running the get ahead of the tariffs, which of course President Trump implemented later on. So now we're, I won't say suffering from that, we're just seeing fewer and fewer imports. Export reading was also not good, so it was 43.4, and that's just not where we want to see it. In other words, the trade numbers, we're looking like more of a mercantilist society where each nation is going to try to be more self-sufficient, and we economists don't support that movement. But anyway, 80% of the businesses that we surveyed reported that labor shortages market was really in balance. 80%, 20% indicated there were more surplus labor, but nonetheless, that was surprising to me that 80% said the market was in balance. That's the labor market. Now here I'll bring up the chart, and you'll see that in blue there, beautiful Creighton blue, you'll see the overall reading, and it is down. It's been down, moving lower each month. And there in black, you'll see the rural Main Street economy. That's moved up significantly. That's good news. Now on the flip side, you see in red there, that's the national PMI. That's showing that both the national and the regional manufacturing sectors are moving lower. And so that's of course what I won't say it's not comforting, it's less than comforting, I'll put it that way. We're seeing some real weaknesses across the nation and in the region, more outside the region. And what do I mean by that? The housing sector is slowing down much faster, slowing down faster. And that's a real concern of mine going forward. The Federal Reserve has indicated they're not going to move on interest rates in July. That is foolish. They should be reducing interest rates at their July the 30th meeting. That should be done. It will probably not be done. It'll probably be September when they do that. So that's something to be concerned about, is the housing sector. Likewise, the stock market, FOMO, fear of missing out. We've also got this passive investing that's pushing up stocks, giving a misleading indicator of how well the U.S. economy is doing. The U.S. economy is not doing well. Jay Powell and the Federal Reserve Open Market Committee, Jay Powell, the head of the Federal Reserve, he says the labor market's strong. He's looking at the wrong data. It is not that strong. He needs to get an update and look at some of the better data and the data that we're looking at, like for example, Creighton University's Purchasing Management Survey that I'm talking about today, and also the National Purchasing Management Survey, which again comes out later on this morning.
What were the hiring trends?
Hiring was flat but down. In other words, the reading was 49.4. Now anything below 50 is growth negative, and now 50 is growth neutral. 49.4, May was 49.4. When you look at overall manufacturing, we're down about 88,000 jobs. That's the U.S. Now that's negative 0.7%. Now if you look at the region, of course, the 9 states that we survey here at Creighton University, the number was down about 9,900 over the last year. I'm talking about over the last 12 months. Down also by 0.7%. So the labor market, despite the president's idea, and well, I shouldn't say an idea, his goal of increasing manufacturing employment, it just hasn't happened yet. Now that'll take, obviously you don't do that in 6 months, but nonetheless, the direction is not strong. The direction is the wrong way in terms of manufacturing employment, and certainly that's keep an eye on that going forward.
What inflation trends are you noticing?
Inflation still, it was up for the month. The price gauge, now this is at the wholesale level, is at 67.9. That's up only slightly from 67.4 in May. So we're not seeing a lot of inflationary pressures. So when the Federal Reserve Chairman, Jay Powell, keeps talking about inflation, he's swinging at the wrong ball, I would say. And on average, but now on the flip side, on average, supply managers expect tariffs to push up input prices by 7.5% in the second half of 2025. Now, what's going on now? Why have we not seen the tariffs pushing up prices so far? What has happened is this is feeding into, I would say, pushing down the margins of the businesses. In other words, instead of passing on that price increase, these manufacturers that we survey, they are taking a hit on their bottom line. It will be the bottom line. Now, right now it's their gross margin. So it's not been passed on to consumers thus far. If you look at the CPI, you look at the PPI, you look at the PCE, personal consumption expenditure, all of them are indicating that inflation is tame. It's tame at the PPI, the producer level. It's tame at the consumer level, CPI, Consumer Price Index. So it's just not there right now. Now I expect it to be there when later on, perhaps not even this year, maybe next year we're going to see something in terms of the PPI, something in terms of the CPI. But right now, nope, tariffs aren't showing up in the data.
What is the economic outlook?
Well, the Federal Reserve's meeting on the 29th and 30th of July. They're probably not going to move on interest rates. If I were a voting member, if I were Jay Powell, there would be a rate cut. There would be a rate cut announced on the 30th of July. There will probably not be. I would say the probabilities are about 30 to 40% that they'll cut rates. More likely, they're just going to continue rates as they currently are. But keep an eye on the balance sheet. That's their action in the bond market. Now, that sounds a bit arcane and a little bit, what we call economic speak. Well, it's not. It's terms of keeping long-term interest rates, bringing them down. Now, that would be if they bought bonds. They're selling bonds, but they may slow those bond sales down. Keep an eye on the CPI month over month. Again, it's not showing inflation at all there, but keep an eye on it anyway. It's certainly an issue, and it could, if we should see a jump up in the CPI or the PCE, personal consumption expenditure, you would see some movement in the stock market right there. But right now it's just timid. Long-term rates will move sideways to a bit down, I think. That's what we're talking about. So when you talk about the mortgage rate moving, and you'll have to keep an eye on the 10-year Treasury. Mortgage rates are based upon the 10-year Treasury yield. And that yield has come down, by the way, from 4.5% to 4.25%. So that's indicating that at least globally and even domestically, investors think inflation is coming down. So Jay Powell is the only person around that thinks inflation is going up right now. He's finding himself, he and the president are going through a little battle. And the president's not helping out by jumping on Jay Powell. I mean, Jay Powell's in charge here. I hate to tell the president, but Jay Powell's in charge. You're not in terms of interest rates. So the president needs to go silent, because all he's doing is pushing Jay Powell into a corner, and it's like a mad wolf in the corner. I'll show you, I'll bite back, and he is biting back by not reducing interest rates. Keep an eye on the bond market, because he and the president are both being pushed by vigilante bond buyers, and that's for economists. That's rich. We love it when individual investors globally, across the globe and internally, domestically, are pushing and saying, well, you may think it's this, you may think it's that, but here's what the real answer is. And they are, by and large, right now saying inflation is not a problem. Now, Jay Powell says it is, the president says it is. Well, the president doesn't say it that way. He just thinks needs to be a rate cut. Anyway, Keep an eye on the national ISM, again, which comes out later on this morning. It's probably going to be down like ours. Maybe it's not in recession territory, but it's moving in that direction. I'm not saying we're in a recession, although we won't know till next year. They'll say, well, you know what? You were in a recession back then. Well, tell us now that we're in a recession. The GDP number for quarter one was negative. The quarter two that we're in right now, it's showing up not very strong, and maybe it will be in negative territory as well. The Atlanta GDP outlook is 1.8, 1.7, 1.9, somewhere in that territory. Not good. That can move even lower. They don't have June numbers, which we're talking about today. That's a real concern. I think we could have a negative number again, and the NBER, National Bureau of Economic Research, they date these recessions. Now, they are always late, of course, and I think we may come back and say that the first half of this year we were in a recession. Price of a barrel of oil, but now I'm short of any action between Mideast, between Israel and of course Iran, that we're going to see oil prices probably move lower, and why is that? Well, because the global economy is slowing down, and the U.S. economy is slowing down, and that tends to push down the price of oil. So that's another indicator that I failed to talk about earlier. That's an indicator that you need to keep an eye on, because that's giving you early warning that the economy is slowing down. Junk bond yield is still too low, meaning investors are too sanguine, I think it's FOMO, fear of missing out. You just don't know. Where are you going to put your money? Well, you're putting it in junk bonds. I'm not. I don't know about you. I'm not qualified to make recommendations about stocks and bonds or your investment decisions. But I'll tell you what I'm buying: gold. I'm buying silver. I'm buying the hard metals right now. And, I do selectively buy stock. I've got Cisco, but that's not a recommendation again. Jobs report will come out on July the 3rd. That's a Thursday. Unusual. That's very rare that we have it, because July the 4th is Friday. So we'll have a jobs report on Friday. Folks, this is not something you can rely on. These numbers jump around like crazy because the sample size is coming down, down, down. And what does that mean? The margin of error goes out, out, out. And that's what you got to watch out for. So when these numbers are revised later on, you find out, holy cow, we lost jobs. We didn't gain jobs. But the point is that investors right now, that's principally stock investors, they just go with the good news, forget the bad news. Start looking at some of the bad news, and we economists, we tend to focus on the bad news, and that's how we are. This economist is. I'm what they call a perma-bear, and that's perma-bear, permanent bear, meaning looking at this gray lining around the silver cloud. Watch the price of gold. It's moving in a range right now that's indicating that investors don't know where to go. They're looking at, is it inflation or is it a slowdown? And that's going to be a real indicator. When that starts to move upward, that's going to indicate the economy is slowing down much more than what the Federal Reserve would like to see. And finally, first-time claims for unemployment insurance. It's a great, wonderful indicator for you to watch. It comes out every Thursday. Every Thursday, first-time claim for unemployment insurance. Look at the continuing claims. Look at the new initial claims going up, up, up. Too much, too much, too much. It's showing that there's layoffs, layoffs, layoffs. And that's a real concern right now. The labor market is much weaker than Jay Powell says it is. And you say, well, who am I to say that? He lives in D.C. I live in the real world out here, and the real world says the job market's getting weaker. So until we meet again, I'd like to see you again next month. May your economic cup runneth over. Ernie Goss here from Creighton University in beautiful downtown Omaha, Nebraska.